Hi, and welcome to this week's look at the major news stories that have impacted the market so far and look likely to rumble on in the coming weeks as well. And we're going to start in the UK, and the trials for the UK stock market continue, unfortunately. Now, on Monday, the Governor of the Bank of England, Andrew Bailey, spoke about the need to control inflation. Now, we've spoken about it before, but it's worth reiterating that inflation is currently higher in the UK than any other major Western economy. And the expectation is for another rate rise at the next Bank of England meeting on August the 3rd. Bailey's final words did boost the value of the pound, which set a year's high Tuesday morning and has continued to rise since then. However, on the other hand, the UK stock market is dominated by negativity. In fact, we saw it approach a year-to-date low earlier this week. And are we seeing bear dominance emerging? Now, there was a small rebound Wednesday, and so far on Thursday, a little bit of positivity creeping back. But I think it's worth taking a look at some of the key levels that we've seen and used recently. 76.80 has ceased to be support. I mean, that's relatively clear, and in fact has already acted as resistance. 74.50, which also used to be support, that's pretty much gone as well. And we are concerned that could be becoming resistance. And if we look at price around midday Thursday, in fact, we're testing that theory a little bit with index around the 74.45 mark. Now, look at slightly lower levels. 72.30 has acted as support this week. It's not clear if this little recovery we're seeing is going to continue from there, but let's hope that 72.30 does remain an important support level. There's a lot of information coming out over the coming days, and obviously things are pretty topsy-turvy, so keep your eye on the markets and don't forget your risk management techniques. So, not the rosiest of pictures for the UK index at the moment, but what about over in the States? And there's been a CNBC Pro Poll, and our strategists suggest that the price of the S&P could fall by the end of this year. Between July the 3rd and July the 7th, 15 reputable strategists were interviewed by CNBC in their Pro Poll. These people included Bank of America's chief equity strategist and Charles Schwab's chief investment strategist, so fairly punchy players when it comes to predicting what's going to happen. Of the 15 interviewed, 9 suggested the price of the S&P 500 in the second half of the year will fall below current levels. And the majority of the rest of them suggested maybe a very small rise. But let's look at the median of the opinion. Now, the median price based on from these 15 people was at the end of the year, the price of the S&P would be around the 42.55 mark, which is less than the current price of circa 44.40, mid 44.40s. So why this slightly pessimistic outlook? Well, they're talking about a lack of growth drivers for the second half of the year. We've spoken recently in these videos how AI and the development of AI has been a real driver for the big tech stocks, for chip makers, etc. But people are saying that there's nothing really pushing that degree of optimism in the second half of the year. We could, of course, also be seeing more Fed rate rises. Now, whilst it might be okay for the US dollar, could well lead to a US recession. Now, Wednesday we actually had the latest figures of CPI out from the States, and it was a year-on-year 3% growth. That was slightly less than expected at 3.1%. So while slightly lower than forecast, taken relatively positively. And we did see a little bit of a fill-up, if you like, to the markets after those figures came out. If we swap over to the chart does show the price of the S&P 500 is rising within the channel, which is shown in blue, which, again, slightly more positive outlook. However, inflation is still in play. There's no doubt about it. Interest rate rises could definitely have further impact. We've also got reporting season coming up. Now, the mood may turn based on what we're seeing coming out of those figures, or if they're positive, may continue to drive this current positive mood, which may fly contrary to what the analysts are saying. So, a lot of differing opinions out there, as is always the way in the markets. The next couple of weeks, 3 weeks, 4 weeks figures coming out are going to be really important. I'm going to come on to those in a second, but definitely keep your eye on economic releases moving forwards. Okay, so we were talking about the S&P a few moments ago. I did mention the fact that reporting season is coming up and could be quite pivotal in what happens in the coming couple of months. So What are we expecting from the reporting season? Well, it begins this week, the Q2 reporting season, and traditionally, first report are the big banks. So we have on July the 14th, JP Morgan, Citi and Wells Fargo. Moving into next week, 18th, we've got the Bank of America and Morgan Stanley, and on the 19th, Goldman Sachs. Obviously, names we've all heard of, key players in the banking market. Now, FT analysts suggest that these banks will show a large increase in loan losses. Not a huge surprise. Obviously, this is due to increasing interest rates. What sort of impact, though, is that going to have on the markets? Well, disappointing figures may give rise to more recession talk. We hinted at that earlier as well. And in fact, Treasury Secretary Yellen said in an interview on Sunday that she doesn't rule out completely the risk of recession. So that ball is still in play. Analysts at Bloomberg Economics believe baseline scenario for US recession will begin towards the end of this year. Now that ties in with what we said some analysts were saying about the S&P, despite the chart showing a little bit of positivity. Reporting season this time around is going to be worth watching very, very closely. That chart of the S&P shows that its price is moving within the ascending channel. But any negative surprises coming out of these big banks in the next few weeks may well completely turn that on its head. I said, keep your eyes on economic announcements, but do follow the reporting season over the next couple of weeks. There is bound to be something in there that gives the markets a little bit of a jolt one way or the other. Okay, finally, we're going to take a little look at a Forex pair, and the Swiss franc strengthened to 2020 pandemic levels this week. A dollar against the Swiss franc rate fell below 0.87 for the first time since the spring of 2020. Obviously, we were amidst coronavirus pandemic then, and the Swiss franc was seen as a safe haven amid all the panic that was going on. Now, since then, obviously, we've seen a lot more dollar strength. We do know the dollar index is not having the greatest of time at the moment, but why this sudden push? Well, it's possible that the ongoing hostilities in Ukraine and the newer developing tensions between China and the US are fueling demand for the Swiss franc once again as a safe haven. That's all ongoing. We know about these sort of things. What do we think may happen moving forwards? Well, hope for the bulls could be given by the following couple of inputs. The lower line of the long-term channel, which is red on the chart that we're looking at, from a TA perspective, that could become support for a rebound. Now, better than expected figures as well. We talked about economic announcements, and we look at CPI on Wednesday out of the US. That was, although it was only 0.1%, that was still better than expected. And if we see perhaps further figures such as that, better than expected figures could just help strengthen that US dollar slightly. We've also got FOMC members speaking about the latest CPI figures, about what the FOMC is looking to do in the coming months. First of those is Thursday evening, and any mention there of rate hikes also may well strengthen the US dollar, although obviously there are concerns abound about the US going into recession. So we've got competing aspects going on, but again, really, really important that as traders we take notice of economic figures and data that's coming out and talk from the major market participants and decision makers. I think it's going to be a volatile couple of weeks. So risk management techniques, don't forget them, and we wish you luck with your trading in the week ahead. Bye for now.